Hey guys, so we've all been hearing about the RBI increasing the repo rate by 40 basis points and the stock market being down by almost 4% since last week. And I'm sure we all have questions like, will the inflation increase? How and where should we invest? So let's break it down. So the repo rate is the rate at which RBI charges banks for lending money, and it was increased from 4 to 4.4%. The increase in repo rate means more expensive borrowing for the banks, which in turn means that it will be more expensive for us to get loans. RBI's mid-cycle hike clearly means the inflation situation in India is very serious. The inflation reached almost 7% in March and would have possibly reached almost 7.5% in April. Apart from inflation, high crude oil prices, geopolitical tensions, and shortage of commodities could have led RBI to take this decision. Now let's talk about the impact of this on the borrowers. If you're planning to take a loan, then you might do it sooner than later, as the rate of interest might start increasing soon. And if you already have loans, then it's recommended that you pay higher EMIs as compared to increasing the tenure of the loan. If you're wondering what would be the impact of this on the stock market, then the interest rates in the stock market have an inverse relationship. Every time the central bank increases the repo rate, its immediate impact is seen on the stock market. The Sensex fell 2.29%, that is over 1300 points. The Nifty also fell by a similar magnitude of over 16,000 points. This means, following the hike of the repo rate, companies also cut back on the spending and the expansion, which results in the dip of the growth. This affects the profits of the company, the future cash flows, resulting into the fall of the stock prices. However, increase in the repo rate does affect the short-term deposit rates positively. Short-term deposit rates are likely to rise first, but it could take longer for the long-term FD rates to rise. At Stack, we have diversified portfolios for your investments to absorb the impact of such adverse events. Since it is impossible to insulate your investments from such market forces, risk management is the only way to minimize your losses while maximizing the potential returns.